Trinity Chavez for NYSE TV, and joining me today is Art Penn. He is the founder and managing partner of PennantPark, the first episode of our video series on private credit investing. Art, thank you so much for being here today.
Pleasure to be here, Trinity.
So let's start by talking about what is direct lending.
Direct lending is basically firms such as PennantPark raising capital from private investors and then utilizing that capital and making loans to mid-sized businesses. So in a sense, it's very similar to what banks have historically done over the course of time. Our goal, of course, when we make these loans is to make loans that are money good, that where the companies pay us back our interest and then our principal at maturity. So it's very simple. It's an activity that's been around a long time in human history. It's just being done by investment managers such as ourselves these days.
Who would you say are your main competitors?
Well, historically, commercial banks really dominated the market for lending to middle market companies. And by middle market, for us, that means companies with earnings between $10 and $50 million a year. We think that's a massive market. And what happened is right after the global financial crisis, the GFC, many banks pulled back. And this was spurred by the regulators, by the capital charges that the regulators were putting on the lenders, and about just the overall regulatory burden of lending to middle market companies for banks. So over time, banks have receded from the market, and that's given up an opportunity for those like us, the direct lenders, to come in and provide capital to that core middle market companies with between $10 and $50 million of earnings.
And how much do you think that direct lenders manage today? And what sort of trends are you noticing in the sector in terms of cash flows?
So direct lenders, some people think the direct lending market is about a $1.5 trillion market, which has grown dramatically and is poised to continue to grow given the opportunity. In terms of cash flows, it's being driven in large part by both institutional and the retail investor. Institutional being pension funds, insurance companies, foundations, endowments. Many pension funds want to allocate maybe 5% of their overall assets to direct lending. Many have not hit that and are allocating that capital.
Now, I want to talk about, because you touched on it a little bit, about how you think it's an attractive lending environment. Why do you think that is? What is driving it?
Well, in part because most of our loans, the vast majority of our loans, are floating rate loans. So the yields we're getting today are very high, as the base rates, underlying interest rates, have gone up dramatically over the last 12 to 18 months. And it does highlight for investors the fact that there is that kind of floating rate element to it. They're not going to get hurt by fluctuating interest rates like they might in a fixed income bond, where it's a fixed rate that they're buying. Here, the rates fluctuate up and down and really match what's going on with the interest rate environment.
Wow, some very important information. Thank you so much for joining me today, Art.
Thank you.